What is up, YouTube? Welcome back to the channel. Hopefully you guys are having a wonderful day. And if you are having a wonderful day and you want to help me out a little bit, you can go down and smash that like button. It truly does help a small channel like mine out. Today I wanted to cover 5 mental and emotional mistakes that I've made in the market, and then 5 things that I use to kind of combat those things on a day-to-day basis. If you enjoy this kind of content, make sure you go down and smash the subscribe button. And then with that being said, let's get into the video. Without wasting any time, let's get into the 5 mental and emotional mistakes that most investors make that cause them to lose money. And I've fallen victim to a lot of these before, so let's just get into them. The first one I want to cover is the fear of missing out, or FOMO. This is very common. You start seeing a stock move, you feel like if you don't get into it now, you're going to miss out on that move. But what often happens is you're already too late upon the stock moving. So you buy it hoping that it's going to continue going up, and that's exactly when it starts going down, and then you end up losing money on the trade. Number 2 is the revenge trade. So right after you went into a trade and you lost some money on a trade, you feel like you have to do another even more risky trade to get that money back. It's often not rational at all. You just feel like you lost money, so you have to work even harder to get that money back instead of keeping a calm, cool head. The third mistake that most investors make is the gambler's fallacy. A good way to kind of understand this one is if you take coin flips. Everybody knows that you have a 50-50 chance of getting heads or tails. So if you flip that coin 10 times, the expected ratio of heads to tail is 5 heads and 5 tails. But we all know that that's not the only possible outcome. So the gambler's fallacy makes you believe that just because the last 10 trades have all been tails, that for some reason this next coin flip is going to be heads, when it has just as much likelihood of being tails again. Number 4 is watching the get rich quick videos or consuming get rich quick content and all. Nobody knows any way on how to make money quickly. If anybody tries to tell you that this is 100% bulletproof, this is the quickest way to make money, they're probably lying to you, and you need to take that with a grain of salt. And then number 5, the final mistake that most people make is buying a stock based on the stock price, not the actual market cap or the evaluation. So a good example of this is AT&T stock is currently $30 upon me making this video, and the market cap is $215 billion. Meanwhile, Chipotle stock is $1,150, but the market cap is only $32 billion. Although Chipotle stock is a higher amount, the valuation of the company is only $32 billion versus AT&T's $215 billion, and the stock price being $30. Make sure you're not buying a stock just because of the actual stock price, but based on your evaluation of the company and where you think the company is going to be in the future. So the reason why people fall victim to all of these mental and emotional mistakes is a very simple term. It's called cognitive bias. Cognitive bias is where you think that you're always right, you're always making the right choices. And you have to understand that even no matter how much research you did, no matter how confident you are in a choice, you can still end up being wrong. I'm sure there's other tips and tricks out there, but these are some of the tips and tricks that I do to kind of get myself through or kind of avoid making some of these mistakes more often. I still end up falling victim to them. I'm just like everybody else. I feel like these 5 tips really do help me avoid falling victim to them on a more often basis. Number 1 tip is to reevaluate your portfolio often. I do this probably weekly or maybe bi-weekly. I'm always looking at my portfolio and asking why I bought a stock, what does that stock do, and what are 3 reasons keeping me from removing that stock from my portfolio. Number 2, never be afraid to sell or miss a run. So a good way to think about this, for every 1 move that you missed out on, you also missed out on 10 moves to the downside if you're always keeping yourself in check. Number 3, if you get upset from a loss, you were probably over leveraged in that position. That means you had too big of a position, and you probably shouldn't have invested that much money in that risky of a stock, and you should use that in understanding what kind of position sizes you're comfortable with going forward. Number 4, confidence. Confidence is super important when it comes to investing. You have to have confidence in your ability to understand a company or even a sector and understand what kind of trends you're looking at. If you're not comfortable in that sector or that company, don't worry about missing out in that sector or company if you don't understand it. Because if you don't understand it, you don't know what's going to influence that company or what kind of things to look out for. Warren Buffett kind of talks about this. Only invest within a circle of confidence that you have in the stock market. If you are really good at technology, but you're not so good at knowing anything about utilities, maybe only invest in technology vice investing in utilities. Number 5 is always understand what kind of trade or investment you made, because that's going to determine how quickly you either get out of that position or what your expectations should be going into that trade. If it's a short-term trade and you're just looking for a short-term gain, make sure it stays that way and you don't try to change it into something that it's not. If it's a long-term investment, don't be upset if the stock goes down right away because you weren't worried about the short term. You're worried about the long-term vision that you had. So that was all 5, and I wanted to add in a bonus because I felt like it was also important to add. So this is my bonus tip. After you win on a trade, be humble. Come off of your high. You can be excited about it. You can be glad that you made a great trade and you made money, but come off of that high before you take that money and you invest it somewhere else. Oftentimes after a big win, you have all this adrenaline and momentum and you feel like you are untouchable. So you just want to take that money and you want to make the next big trade because you know everything. That cognitive bias is really juiced up. You want to believe that the next trade is going to be the same type of trade. I like to take a little bit of time to myself, put the money or the profit that I made off the trade and just leave it in my account. Don't touch it, don't invest it. Don't think about it until I have calmed down off of that win, and then I go back and invest that money again. So I hope this video helped. I try to take it right to the point and not cover up and make this video a certain length or anything like that. I tried to just get to the point to talk about the topics I wanted to talk about, make you guys aware of the situation, and hopefully you guys can become stronger investors or stronger traders, whichever part of the stock market you find yourself in. I would recommend maybe writing down a couple of these tips, a couple things that you took away from this video, because if you ever find yourself in a couple of losing trades in a row, this might be something that you need to come back and just refocus yourself, recenter. And that's why I'm always reevaluating my portfolio, because I think that's why I put that one at number 1, because it's super important to me. I'm doing that all the time. If I can't come up with answers to those questions, I'm out of it. I'm out of the trade. I don't care if I won or lost. I'm just out. With that being said, I hope this video was helpful. Make sure you go down, smash the like button. Also hit the subscribe button if you enjoyed the video. And I appreciate you guys so much. Peace.